What's going on YouTube? It's Gana Mo. In this video, we're going to be showing you how to analyze the numbers on your next real estate deal so you can make determination if it's a deal or no deal.
Now this will be our first video in a series of videos analyzing your next rental property. So if you don't mind gingerly tapping that like button, and let's get started.
Now before we jump into the nitty-gritty of the numbers, let's take a step back and figure out what the primary goal here is. It's to generate enough income and wealth to live the desired life of your dreams on your own terms. Now to us, each property is an engine that's pulling us towards our financial goals. Now the better the property's numbers are, the more pulling power the engine has. And that pulling power is derived through the wealth it's generating through the equity we have in the property, along with the cash flow that allows us to have that spending money to live out the lifestyle of our dreams. Now that cash flow replaces your need for that job and replacing hours for dollars. And that's the primary reason you started investing in the first place, and the reason that you found our channel and are sitting through this video. So make sure you hit that subscribe button so we can help you reach your financial goals.
Let's focus on the income an investment property can generate. As we mentioned in previous videos, income is defined as the money you earn after collecting rent from your tenants and paying all necessary expenses on that investment property. In a basic real estate scenario, you rent out your investment property to tenants, hopefully good ones, and they get to enjoy that property, they get to raise a family, they live in it, etc. And in exchange, they pay you rent for that property. And after all the expenses paid on the property, maintenance, repairs, mortgage, the money left over is defined as income and is yours to pocket. And hopefully it's positive rather than negative, because isn't the whole point of all this to make some money?
Now this number is important, but how do you use the many formulas out there to best determine how the property you're interested in stacks up to the rest? In this video, we're going to be exploring some of the most important formulas that are going to help you determine and analyze a property whether you're financing or not.
Let's discuss gross rent multiplier. Gross rent of your investment property means the total rent before you start subtracting expenses, deductions, and any other upfront costs. Now, with any investment property, the math starts here, and this is where you should start as well, because gross rent is easy to find and easy to compare to other real estate investments. The gross rent multiplier is similar to that of the price per earnings ratio you may come across in stock market investing. Now, this is helpful because it quickly tells us how good an investment property is at producing an income. And the key takeaway here is the higher the gross rent multiplier is, the less attractive an investment property becomes.
Now let me illustrate a real-life example of that gross rent multiplier. So a property with a gross rent multiplier of 12.5 and that property is selling for $150,000 and grosses $12,000 a year is much better at producing income than a property that has a gross rent multiplier of 16.6 selling for $250,000 a year and has a gross yearly rent of $15,000.
Another formula, or shall I say a rule that we have to look at, is the 1% rule. Yes, the infamous 1% rule. Now the 1% rule takes into account the monthly rent rather than the yearly rent, which is analyzed under the gross rent multiplier. And the 1% rule states that the gross rent of a property should equal at least 1% of the purchase cost of that property in order for it to be deemed a valuable investment.
For example, a property that has a total upfront cost of $300,000 that includes your purchase price, your closing costs, and any repairs you want to throw in there, that property would need to have $3,000 in monthly rental income to meet that 1% rule. Now to be honest, that is not possible in every market. It's definitely not possible in my market here of South Florida. A lot of those properties do not meet that 1% rule. As such, it's important to realize that all these formulas are just tools to help you analyze a property. They are not rules. Just because a property matches a specific rule does not deem it a good investment. I have personally seen properties that meet the 2% rule that are bad investments just because they were in the wrong location, they were completely run down, or they had management problems. The best way to use that 1% rule is for a quick and easy analysis of a property. If a property does meet that 1% rule, it's just one sign that you have an interesting investment candidate in front of you, and you should actually go and follow up and get additional information about that property. That was actually the triggering call for myself whenever I was looking for properties out of state.
Now let's define two very important variables when it comes to real estate investing: cap rate and net operating income. Now, the cap rate is a very important income calculation because it tells us how well a property produces in income after expenses. And in order to find the cap rate, you take the net operating income and divide it by the purchase price of that property. The net operating income is the property's gross rent minus the property's operating expenses and deductions, such as repairs, maintenance, taxes, HOA fees, vacancies, etc. But keep in mind, the net operating income does not take into account the financing expenses associated with that property.
Now let's compare two different properties and use their respective cap rates to compare them. So the first property has a total net operating income of $5,000 per year and has a total upfront cost of $100,000. 5,000 divided by 100,000 gives us a cap rate of 5%. Now the second property has a total net operating income of $15,000 and a total upfront cost of $600,000. So the cap rate would be $15,000 divided by $600,000, and that would give us 2.5%. Now, property do you believe is going to get you to your financial goals faster? Now you might be asking yourself, how else can you use the cap rate of a property? We simply use it as an investment goal. If a property has a lower cap rate than the desired one we're looking for, we simply pass on that property. Also, cap rate of a property is typically what appraisers and brokers refer to whenever they're quoting a property or referencing a property. There is typically a going cap rate for a market, and that's referred to as the market cap rate. Now here in South Florida, that's typically between 5 and 7%.
Now, in order to calculate our expenses quickly on an investment property, we use the 50% rule. Now, the key here is that the 50% rule provides an estimate and not a definitive analysis of your investment property, but it does help to estimate your net operating income and the cap rate. And the 50% rule assumes that 50% of your gross rent will be lost to operating expenses. Therefore, 50% of your net operating income will be your gross rent. For example, the estimated yearly rent of a real estate investment property is $20,000. Now, 50% of that is $10,000. Now, let's say that property's estimated value on the purchase is $200,000. Well, now the cap rate equates to $10,000 divided by $200,000, which equals 5%. Now remember, this is just an estimate and should not be used as a definitive number when it comes to looking at that real estate property itself.
Until now, all the income analysis we've been showing you did not take financing into consideration. Now, most real estate deals do include financing. As such, it's very important for you to know how much income is left over after you factor in that financing cost.
Now, we hope this video provided you with a solid foundation to start analyzing your next real estate investment property. And as such, we hope you check out our next video in which we'll be diving deeper into the financing aspect of real estate. And as always, don't forget to subscribe to our channel, and we'll see you next time.